Welcome back to the show. Today, I want to start with an image that I think perfectly captures what has been quietly happening to the global financial system over the past 30 years. Imagine you walk into your favorite enormous supermarket, the one you've been going to for decades, the one you trust implicitly. You know every aisle, but lately you started noticing something strange. Aisle by aisle, the store is actually shrinking. The best local brands, the exciting up-and-coming products, the ones everyone is talking about, they just aren't on the shelves anymore. You ask the manager where they went, he points to a walled-off VIP warehouse in the back of the store and says, well, they're back there now, but you don't have the right membership card to get in. That is a genuinely accurate picture of what's happening to public markets right now. The shelves are getting bare, and the high-growth products are being locked away. Let me put a number on it. Rewind to 1996. Back then, there were roughly 7,300 publicly traded companies in the United States. Today, around 4,300. Where did nearly 3,000 companies go? Because businesses don't just evaporate into thin air. The answer is that they move to the private market, a place where ordinary retail investors like you and me can't easily buy them. Today's mission is to walk through exactly how that happened, why it's accelerating right now, and most importantly, what it means for your retirement money. I've pulled from a really dense stack of research: market analysis from EQT and Aventus Advisors, regulatory overviews from the Harvard Law School Forum, retirement asset trends from Robertson Stevens, and private credit stress test data from HedgeCo and With Intelligence. Quick disclaimer before we get into it: this is general financial and economic analysis, not investment advice. Before we get into it, quick note: if this is the kind of analysis you come here for, hit the like button and subscribe. It's the single most useful signal you can send that this kind of work is worth doing. Takes a second, means a lot. Now, let's get into it. The disappearance of publicly traded companies isn't the whole picture. To understand the shift, you have to look at what happened on the other side of the coin. During that exact same window, from 1996 to today, while public companies were disappearing, the number of private companies backed by private equity firms went from roughly 1,900 to over 11,200. Read that again: from under 2,000 to over 11,000. And you can see the shift most clearly in the initial public offering, the classic IPO bell ringing ceremony. Historically, the IPO was the mechanism companies used to actually join the public stock market. Between 1980 and year 2000, the reported average was more than 300 companies a year ringing that bell. Today, that number has plummeted to fewer than 100 a year. The traditional dream of taking a company public is basically dying. The first force everyone talks about is regulatory burden. According to the research, ongoing public company compliance costs is average around 4.1% of a company's total market capitalization every single year. That's not a one-time IPO fee, that's every year, forever. And the reporting requirements are relentless. Over a recent 5-year stretch, the length of annual reports grew 46%. The reported average FTSE 100 annual report is now around 147,000 words. Think about that. If you love a good novel, that's a decent-sized book of pure corporate compliance jargon. Doing an IPO today is like throwing an incredibly expensive, lavish wedding. But the catch is that by signing the marriage certificate, every single guest gets the legal right to aggressively audit your personal finances every 3 months for the rest of your life. Why would a company willingly sign up for that if they didn't absolutely have to? But we have to be careful not to place all the blame on regulation. As a counterweight, some academic research suggests that regulatory costs actually account for only about 7% of the decline in public listings. Just 7, which seems shockingly low given how much executives complain about red tape. It's low, but it makes sense when you look at the broader mechanics. The real driver is the vast availability of private capital. 2 or 3 decades ago, if a company needed to raise $1 billion to build new factories or hire thousands of engineers, the public stock market was really the only place with that kind of cash. You had to go public to get the big bucks. That is no longer true. The private markets have grown so deep and so liquid that a company can find all the funding it needs from institutional investors without ever setting foot on the New York Stock Exchange, which gives a CEO incredible operational freedom. If you don't have to obsess over hitting quarterly earnings targets to appease a mob of public shareholders, you can actually plan a business strategy for the long term. If you need to spend 2 years losing money to build a revolutionary new product, you just do it. The data confirms this behavioral shift completely. Companies are now choosing to stay private for an average of 16 years before even considering an IPO, reportedly about 33% longer than they waited just a decade ago. There's a Microsoft anecdote from 1986 that perfectly illustrates how much things have changed. When Microsoft went public back in 1986, the only private capital they had ever raised was a small early investment from a venture capitalist named Dave Marquardt, and Bill Gates famously said they didn't even need the cash. They literally just sat in the bank. They only took the investment to get Marquardt's expertise on their board. Because Microsoft went public that early in its life cycle, it generated almost all of its exponential growth after it became a public company, which meant ordinary retail investors, people like you and me, got to buy in early and participate in all that wealth creation. That dynamic is completely inverted today. Private assets have grown so much, doubling from a reported $9.7 trillion in 2012 to $22 trillion in 2024. Projections suggest that number could hit a staggering $65 trillion by 2032. Because of that mountain of private money, companies stayed private during their most explosive growth phases. By the time a tech unicorn finally does go public today, they are often already mature, slower growing behemoths. The explosive 10x or 20x growth already happened behind closed doors. The public market is basically becoming a retirement home for mature legacy companies, while the private market is where all the aggressive wealth building growth is now happening. And that directly impacts you, the listener. If you are passively investing your retirement savings in an S&P 500 index fund, the pool of companies you are buying is shrinking and becoming dangerously concentrated. According to reported market data, just 7 tech stocks, the so-called Magnificent Seven, now make up roughly a third of the S&P 500's total value. The public market you have access to is fundamentally narrower and far more top-heavy than it was 2 decades ago. Institutional investors like pension funds and university endowments recognized this trend years ago. They knew they couldn't just rely on a shrinking public market, so they aggressively flooded into private equity and private credit for diversification and higher yields. But if all the wealth building growth is trapped behind that VIP velvet rope, are regular people just out of luck forever? Regulators are now trying to answer that question, and this raises an important issue about how we legally define access. Historically, private market investments were gated. You had to be what's called an accredited investor or a qualified purchaser. In plain terms, that meant you needed $1 million net worth or a very high annual income to participate. The underlying logic was that private investments are complex, opaque, and highly illiquid. You can't just sell them on an app on your phone. So the rule said only wealthy, sophisticated investors who could actually afford to lose their money should be allowed to play in that sandbox. But the walls of that sandbox are officially coming down. In August 2025, U.S. regulators issued an executive-level directive aimed at democratizing access to alternative assets for everyday retirement account investors. Then, in March 2026, labor regulators followed up with a proposed rule establishing safe harbors for including private equity and private credit in standard employer-sponsored retirement accounts. Let me translate safe harbor into plain English. Think of it as a legal shield. Usually, the HR department or the committee managing your company's 401k is terrified of being sued if they put a risky or complex investment on the menu and employees lose money. This new rule essentially gives those employers a legally protected pathway. It tells them, if you follow these specific steps, you won't get in trouble for offering private equity funds to your workers. By doing this, the old wealth tests are being bypassed. The idea is that your employer does the vetting so you can allocate a portion of your retirement savings to these high-growth private assets. Now, I have to push back here because while democratizing access sounds great on a press release, this is genuinely risky in practice. Private market strategies are fundamentally different from buying a standard mutual fund. They often require a 7 to 10 year lockup to actually realize the returns. Putting a 10-year illiquid asset inside a retirement account is like putting a 10-year time lock on the vault that holds your emergency fund. Consider the reality of an average worker's life. People change jobs and need to roll over their retirement accounts to a new provider. They face sudden medical emergencies or divorces and need to take hardship withdrawals. Or they reach age 73 and are legally required to start taking required minimum distributions under the tax code. You cannot just sell a fraction of a private equity buyout fund on a random Tuesday afternoon to pay for a surprise hospital bill. If a portion of your retirement balance is sitting in an illiquid private fund that only opens a tiny withdrawal window once a quarter or sometimes only once a year, your assets can get stranded exactly when you need them. And then there are the fees. Alternative assets carry materially higher expense ratios than the cheap passive index funds that dominate retirement accounts today. Over a multi-decade horizon, paying 2% in fees instead of 0.05% compounds dramatically. It can severely eat away at your long-term returns. Here's where it gets really interesting. This big regulatory push to bring retail money into the private markets is happening at the exact moment those private markets are facing their first systemic stress test in years. And it all traces back to a word we hear constantly right now, AI. Over the last decade, private equity firms absolutely fell in love with software as a service SaaS companies. They love the business model, recurring monthly revenue, sticky customer bases who rarely cancel, and incredibly high profit margins. Because those revenues look so stable, private credit lenders happily provided billions of dollars in loans to finance the buyout of these software companies. But then, generative AI arrives in full force, and suddenly everyone realizes that AI coding agents and automated workflows can replicate a lot of what these expensive SaaS platforms do. Instead of paying $100 a month per employee for a software tool to organize data or manage customer service, a business can ask an AI agent to do it for pennies. Suddenly, the recurring revenue those massive loans were based on looks incredibly fragile, and the market completely panicked. The panic is clearly visible in the data. Research from Arventus Advisors shows that reported public SaaS valuation multiples, specifically the enterprise value to revenue multiple, plummeted from roughly 18 times revenue in late 2021, all the way down to 3.4 times revenue by March 2026. Let's ground that. It means if a software company generates $1 million in yearly revenue, investors used to value that entire company at $18 million. Today, they only value it at $3.4 million. It is a violent, drastic repricing of what these companies are fundamentally worth, and that fear immediately became a contagion that spread into the private credit markets. According to the reported data, software makes up nearly 20% of the portfolios inside non-traded business development companies, or BDCs. If you include adjacent tech services, that exposure jumps to over 35%. Quick definition. A BDC is basically a fund that acts like a bank. It pools money from investors and lends it out to medium-sized private companies. Non-traded BDCs became incredibly popular with retail investors recently because they offered really high dividend yields. But the key word there is non-traded. You can't just sell your shares on a stock exchange if you get scared. You literally have to submit a request and ask the fund manager to give you your money back. In the first quarter of 2026, a lot of investors got scared. They looked at the collapsing software valuations. They saw default rates on private credit loans ticking up, with Apollo's mid-cap fund reportedly hitting a 5.3% default rate and FSKR reportedly hitting 8.1%. They decided they wanted out immediately. It was a classic run on the bank, or in this case, a run on the gates. According to reported figures, the 12 largest non-traded BDCs were hit with over $15 billion in redemption requests in a single quarter. $15 billion. That represented an average of 12.1% of their total assets. And for the first time ever, the industry saw net outflows. 6.9 billion left these funds, while only 4.9 billion came in. So what did the funds do? 7 of the 12 enacted a gate. They capped withdrawals at 5%. They told investors, sorry, we are only honoring a pro rata portion of your request. Let me translate pro rata because it's a harsh reality check. If you're an investor and you ask for $10,000 back and they say they're only honoring a 5% pro rata portion, you're only getting $500. The remaining $9,500 stays locked up until the next withdrawal window where you have to ask all over again. I want to steelman the industry's perspective here because it's crucial not to view this strictly through the lens of panic. Regulators have stated these risks are manageable. A redemption gate is not a default. It's not a sign the fund is going bankrupt. It's a built-in, legally disclosed liquidity feature designed to protect the fund from having to hold a fire sale of its assets at depressed prices just to pay out fleeing investors. It's like a bouncer at a crowded club. The bouncer isn't putting his arm across the door because the building is burning down. The bouncer is there to keep the crowd orderly so nobody gets trampled on the way out. And you have to look at the underlying loan structure. The reported average loan-to-value LTV ratio in these BDC portfolios sits around 41.5%. Think of a LTV like a mortgage. If you buy $1 million house and take out a $415,000 mortgage, your LTV is 41.5%. That means housing prices would have to drop by more than 58% before the bank actually starts losing a single dime. So in the corporate world, even if a software company's valuation drops 30 or 40% due to AI fears, the private equity owners, the ones who hold the equity, take that loss on the chin. The company would have to lose more than half its total value before the actual private credit loan is impaired. That massive equity cushion is a very significant shock absorber protecting the lenders. Mathematically, sure, the loan on paper is safe, but I have to push back on the idea that this is entirely reassuring. Because if you are a retail investor who just got told you can't have your retirement money back to pay for your kids' college tuition, you don't care about the structural integrity of the equity cushion. You don't care that the bouncer is keeping things orderly. All you know is that you are locked out of your own money. The psychological reality of being gated is terrifying regardless of the math. Let me distill this into 3 practical takeaways. First, if you're a standard retail investor relying on passive public index funds, you have to realize that your portfolio is much narrower and much more concentrated at the top than it was 2 decades ago. The most dynamic growth is happening in the private markets, and it is completely out of your reach. Second, gaining access to these private markets inside your retirement account might sound like a golden ticket to higher returns, but it's not an automatic win. It's a trade you are making, a very specific binding trade. You are trading the low fees and daily liquidity of public index funds for complex, opaque structures with long-term lockups and much higher fees. And third, the most important one, liquidity, is a feature you only truly value on the exact day you need it. A 10% private credit yield looks amazing on a quarterly statement. But if a redemption gate drops on the day you need to pay for a major life event, that yield doesn't help you at all. That is a trade-off that requires serious consideration. I want to leave you with one final, somewhat provocative thought worth genuinely sitting with. If the most innovative, high-growth companies continue to stay private indefinitely, relying on these endless pools of private equity and private credit, and if the public stock markets are increasingly treated as a dumping ground for mature, slow-growing legacy businesses that just want to cash out, will the very concept of the public stock exchange eventually become obsolete? Could future generations look back at the stock market not as the vibrant engine of wealth creation we grew up with, but as a heavily regulated, slow-moving public utility? You walk into that supermarket 20 years from now, and the public shelves are entirely bare. Everything you actually want to buy is locked away in a VIP warehouse out back. And the only question left is who holds the key. Thanks for going down this one with me. I'll see you on the next.